I'm going to welcome everyone to the July version of the Ag Economic Dialogues. We've got two presenters for you today. And so with that, I will turn it over to Tong, and she can introduce herself and the project. So take it away, Tong.
Okay, so I'm going to share my screen first to make sure everyone can see it. Okay, can you see my screen in a larger mode now?
Yes.
Okay, so my name is Tong, and I'm an associate professor and advanced production specialist in SDSU. I'm going to talk about the optimizing fertilizer use to increase profit, because there is we know the fertilizer price have changed a lot recently. So I kind of try to combine our survey result to share some insight on this issue. So the topics I'm going to cover today, at first I look at the fertilizer price change over time, and then talking about how to optimize fertilizer use to maximize profit, and then talk about the difference about the profit maximizing versus the yield maximizing fertilizer use. And then I'm going to share my last year, Midwest Farmer Survey findings of the 4 states, South Dakota, North Dakota, and Nebraska, and Minnesota. So we found some spatial variation in the nitrogen use rate. And I'm going to say the producers, past, present, and future targeted nitrogen use. And we do find some effects of different conservation practices. It has some effect on the nitrogen use, so I'm going to introduce them all. So those are the topics. So first of all, I compiled this fertilizer prices for the 2015 to 2022. Over the 4 fertilizer, we can see that data source is DTN, and we can see that the 4 fertilizer all follow the same trend. We can see a clear trend is at the end of 2020, beginning of 2021, there is actually a huge jump in the fertilizer prices since 2021 and up to 2022, and we see a very slight drop in July of 2022, but it's just not very much. So that's the current trend, and I think the slight drop is because it's not the production season, so the fertilizer demand is going down, so that might be the reason causing the slight drop in the fertilizer price at this moment. So that's the trend over the last 7 or 8 years. Until 2020, end of 2020, I think it's kind of stable over the years, but it's just kind of going to a peak 2022. It's similar to the 2008 and 2009 time is going to another peak. So about the nitrogen fertilizer use, so I'm going to focus on the nitrogen now. I try to talk about the corn after soybean. So this graph I took from a Iowa paper, but it's similar. All the fields is kind of following a similar trend. So we can see that in Iowa, that particular site without nitrogen, this has been the without nitrogen yield is 120 bushel per acre. Different fields have a different yield, but this is without. And then there is a 20 pound, increase in the nitrogen by 20 pounds. We can see that over when it increases of only 20 pounds, this black black portion just stands for the just the effect of fertilizer. And then when it increases for 40, and then there is another black portion that stands for another just effect of the fertilizer when there is an additional 20 pounds. So we can see that when it increases over 21 at a time, so we can see the black portion of these bars, it keep on going down. So it's going down to a point that, you know, when it reaches 160 pounds of nitrogen per acre, it's barely recognizable, this black portion. So in that way, we see that there is a diminishing return to the nitrogen. So it's the yield won't go down, but it's just the nitrogen effect is not as obvious as before 140 or so there is a optimal level to maximize yield. So this is yield side. So for the profit side, I try to just scratch some formulas so that we can see the relationship between the the optimizing of fertilizer for the yield perspective and how to optimize fertilizer from the profit perspective. What's the difference? So I look at the gross return. So if we look at the gross return is basically the crop price times the yield. So the crop yield, we can see it as a function of the fertilizer use, the soil properties, the rotations, whether different factors actually affect yield. So the net return not just depends on the crop return price and yield, it also depends on the input cost. So we have to minus the input cost. So I just think, because I try to study the effect of fertilizer, so I kind of isolate the fertilizer here. So the fertilizer use times fertilizer price, but I put all the input costs together because it's not the interest of this topic. So if I want to maximize my net return, so I can, I want to show the maximization condition here, but eventually I can see that my optimal fertilizer use actually depends on the soil property, depends on the rotation, other factors. Also, it depends on the ratio between the fertilizer price and the crop price. So this ratio is very important, and not just the fertilizer price itself, but it's a ratio that actually affects the optimal fertilizer use. So we can see that the yield maximizing fertilizer and the economically optimizing fertilizer is different. The yield maximizing fertilizer use does not contingent on the fertilizer price or crop price, but economically optimizing fertilizer use actually depends on all the factors that matters to a yield. It also depends on the factors that that I just mentioned is the ratio of price of the nitrogen fertilizer and the corn grain. So that's just some basic principles that guide our decision. So if we look at try to look at the ratio, just now I showed that there is a sharp increase in end of 2020 on the fertilizer prices. Now I try to look at the corn prices and the fertilizer prices together. So we can see that the two of them follow the very similar pattern up to end of 2020. Then after 2021, the fertilizer price actually steadily increased. There's no decrease at all, but the corn price, this is the US corn price. So it kind of dropped somehow at the end of 2021, but then going up again, 2022. So I tried to look at the ratio, but before that, we can see that it's generally follow the same trend. So we try to look at the ratio of what I just mentioned. So this is the nitrogen price over the corn price ratio. So the nitrogen price, I converted the urea price from the tons per dollar per ton to dollar per pound of nitrogen. So that's a different unit from what I showed before. And this crop price ratio is the dollar per bushel of corn. So we can see that there is a range between this, this ratio is falling in. So the lowest point I can say is 0.09, which is only reached by, kind of occasionally. Sometimes this is a low point. The low point means that the nitrogen price compared to the corn price is really low, which means economically, the fertilizer that optimizes the profit actually should be higher. And at some point, especially if we look at recently from end of, sorry, I think I just, end of the 2021 to recently, 2022, we can see there is a very sharp increase in this ratio. And then in the recent several months, it's kind of a drop a little bit, but still in the high level here. It's about 0.15, and in the high point is about 0.18. So at those high ratio level, so the optimal nitrogen use to maximize profit should be lower. So I will give you some examples to show how different optimization levels will differ when we have different ratios. So this is, I try to find some guidance on the ratio and the optimal nitrogen usage. So this is what I found in Minnesota. I didn't find an example in South Dakota, but this is in Minnesota. And the first chart here is different rotation. The second chart here is different type of soils. So we can see that rotation and the soil actually affects nitrogen usage. However, besides that factor, rotation and soil, we also have the ratio affects the usage as well. So the ratio here is showing on the horizontal axis here. You can see that it actually, that this ratio increases from 0.075 to 0.15. So, and then on the right-hand side, it increased from 0.05 to 0.2. So which is a very high ratio. So we can see that at this ratio going up, we see that whatever rotation it is, whatever soil condition it is, we have the optimal nitrogen usage actually going down substantially. So we can see that when the ratio is, for example, in the first panel is 0.075, is the optimal level is 190. This, like 190 tons per, I think this 190 pounds per acre. But then when it reaches 0.15, the ratio actually doubled. So we have only 155 pounds pounds nitrogen per acre. So this is a drop, depends on the price ratio. And similarly, I found this in the Iowa Extension website. So we can see that different regions in Iowa, they have the main Iowa and Southeast Iowa. We can see that there are regional difference. For example, this Southeast Iowa always use more fertilizers than the main Iowa, but there are also the rotational differences. We can see that, of course, the corn after soybean use significantly lower amount than the corn after corn. But the same time, I want to point out that this is the ratio effect is very obvious. So we can see that from the corn to corn, it drops from the 240 to 180, just because the ratio have increased from 0.05 to 0.2. So that's something we need to pay attention, not just to the soil test about the rotation, but need to look at the ratio, not just the fertilizer price either. So find the fertilizer price, find the corn price, and look at the ratio. It kind of determines the optimal price that optimal nitrogen use that optimize the profit. So next, I'm going to introduce a little bit about our survey result. So our survey is carried out in July to September 2021. We surveyed 6,000 Midwest farmers and received 1,119 back. So it's about a 20% response rate. So the region I have covered here shows that we have covered the corn producing regions in the 4 states. I have two map here. The first map is about the chemical nitrogen use, and this one is about manure use. So we can see the chemical fertilizer use is much higher than the range here shows the manure use, and there are some patterns, regional patterns. We can see that because it goes from lighter to darker. So the darker areas, we can see that has a highest fertilizer use compared to the lighter areas. And we can see that the chemical fertilizer and manure use, the highest regions are different. For example, the chemical use, we can see that the use in Nebraska here is highest, and for the manure use, Minnesota has the highest level of manure use. So this is some regional pattern in the 4 states. And South Dakota, I'm just to summarize, if we look at state-wise, so I asked people about not just their current use as of 2020, but also their previous 5-year use, 2015, and their target use in 2025. So we can see that the chemical use of the 4 states, as we see that before, Nebraska has the highest level of usage in all 3 questions. And for the South Dakota, Nebraska, North Dakota, they are not significantly different, those 3 states, although there are some number differences, but this statistically is not very different. So it's around 145 in 2020 in South Dakota, and it's a kind of increase over the last 5 years from 2015 to 2020. It's kind of increased from 134 to 145, but the target use actually again dropped to 128. So we can see that this from the previous year survey we have last summer, the most producers actually intend to drop their chemical use from 2020 to 2025. And this is the manure use. Manure use, again, we can see the significantly, this is the Minnesota has the highest use, but the other 3 states is not very different statistically. But South Dakota, we can see actually not in the number is higher than the other 2 states. This is North Dakota, and this is Nebraska. So we can see that South Dakota is actually the second in place when compared to the manure fertilizer. So the manure fertilizer, we can see that there is a slightly intention to drop, but it's not significant drop in the next 5 years from the producer intention side. So this is the overall trend. We can see that is a manure, you know, from the past to current, it increased, but from current to target is almost the same. But the fertilizer use, average producers fertilizer use is going to drop from 155 per pound per nitrogen to 140 pound nitrogen per acre. So there is a going to be a decrease in the nitrogen use. And we ask the producers if there is a change in your nitrogen use over the past 5 years or 10 years, what's the reason for the change? We can see that the reason here, most producers, because they can check multiple reasons, so there could be multiple reasons for one producer. So we can see that the reason here, the highest possible reason here is the change in yield goals. So basically, most producer, because their yield goals change, so their nitrogen use have changed. And also, more than half of producers identify they have a soil nutrient test data. So that's also a cause for their changing nitrogen use. So the third highest is precision nutrient application. And the other reasons also include the diversified crop rotation, cover crops, livestock integration, and continuous cropping. So those are the some of the reasons that have been identified as a change in nitrogen use over the past 5 or 10 years. So next, I'm going to take a look at how different conservation practices will affect farmers' chemical fertilizer usage. So I divide the producers based on their conservation usage status. So basically, if they have the diversified crop rotation and not diversified crop rotation, I separate their usage in different bars. So here, this red side, for example, is the adopter of DCR, and this pink one is the non-adopter of DCR. So we can say that DCR users, that is diversified crop rotation users, actually have significantly lower level of nitrogen use than the producer use traditional rotation. So here I define the diversified crop rotation as the producers have at least 3 crops, not just 2 crops. And the traditional crop users are either 2 crops or 1 crop. So on average, diversified crop rotation actually significantly reduced the chemical fertilizer. But for the manure is not decreasing, is actually a little bit higher, the current usage. And another factor is the livestock integration. So we can see that producers integrate livestock. They also use a lower chemical level than the producers who does not integrate livestock. But this lower level actually is compensated by the higher level in manure. We can see that their manure use is much higher than the non-livestock integrators. So that's 2 different practices. And if we look at no-till and cover crop, we can see that no-till is not going to reduce the nitrogen use. And we can see that no-till actually increase nitrogen use because there are more residues there. So the producers are recommended to use more nitrogen in the first few years of no-till. And the cover crop, because most people have used cover crop for a relatively short time. So even though cover crop reduced the nitrogen use by a little bit, but it's not very significant, but the number is lower here. So if we put all the different practices together, so here, these different charts is basically the effects of different practices to the producer's use of nitrogen. So we can see that the practice that going to have the highest effect on the nitrogen use is diversified crop rotation. We can say that this line here, the trend line, that means the non-adopters of diversified crop rotation has the highest nitrogen usage, but the adopters have the lowest nitrogen usage. It's consistent between the past, current, and target. So it's this is consistent. And then the ICL also has a effect. So that this blue line, dark blue line is adopters of integrated crop livestock, and this one is not integrated. So we can see that when it's integrated, producers use a significantly lower chemical nitrogen because of their high use of manure. Okay, so the concluding remarks from the previous slides is we found that the surging nitrogen price will not affect the yield maximizing nitrogen, but it will reduce the profit maximizing nitrogen, which actually depends on the ratio of the corn and fertilizer prices. So when we compare the 2020 with the 2015 nitrogen fertilizer, we can see that producers use significantly high amounts of nitrogen fertilizer in 2020 we compare to 5 years ago, but they actually target to use a significantly lower amount by 2025. I think probably because at that time they already sensed a high price. So this is actually offered some benefit to say, because previously when the fertilizer price is low, producers sometimes use a overdose of fertilizer. It's kind of treated as insurance against the low yields. And so now, because the high price of fertilizer actually try to lower the amount of fertilizer used, is kind of provides some producer opportunity to test whether this insurance is actually necessary to ensure the high yield, and it also provides the environmental benefit as well. So we can see that among the conservation practices that reduce producers' chemical nitrogen use, diversified crop rotation is the best practice that can reduce the nitrogen use, and followed by the integrated cropping livestock system. So that's my concluding remarks. So thank you for your attention. And if you have any questions, you can either ask now or maybe afterwards.
Yeah, if anybody has a question, we can take that quick. Otherwise, we will follow through with our traditional layout of the presentations and then do the questions at the end when we turn the recording off. So Tong's contact information is there if you wanted to jot that down, if you needed to contact her about some of those points as well. I don't see anything in the chat or anybody's microphones being unmuted. So with that, we will turn it over to Jack and some more discussion on input costs and where things are kind of going with that whole interest rate component. So thank you, Tong. We appreciate that.
Thank you, Heather.
There. Okay. Jack Davis, I'm the field specialist out of Mitchell office. Just for a quick introduction again. Yeah, we're going to look at input cost and then also interest rates, which hasn't necessarily been a factor in the past probably 10 years almost. And as it's starting to rise, we'll take a look at that and some comments on that and what it will do to projections. We'll get started here. Maybe. Yeah. Page down works. So if you've followed or seen some of the stuff I do, I generally use FinBin, which is out of University of Minnesota, and it's farm records that are stored there in the database by producers that belong to record-keeping groups. And I pick on the states of South Dakota, North Dakota, Nebraska, and Minnesota. And for this data, I used 1,000 to 2,000 acre farms and just picked out what I feel are the top 5 expenses, kind of comparing their gross revenue, just a lot of numbers, did a little projection on 22 and 23, kind of knowing their cost, what we've got going into it in 22 and just what we anticipate or expect maybe for 23. And I'll go through each of these just a little bit going forward. So probably 21 and possibly 22, some of our better profit years or net income years, if guys are able to produce the yield. And then probably looking at reduction in price going forward in 23 as of right now, and yet continued input cost rises. So you'll see that our net could possibly drop going into next year. So breaking each of those down, before, so say early 2000, and I'm going back quite a bit, but even 2008 to say 12 or so, the seed was about 11% of gross. So when I use these percentages that you see there, that is each line item divided by gross revenue for corn. So that's what that 14% is. And then 13, seed felt it could capture a larger share of gross from producers. So it moved to 14% of gross and remained really above 15% until 2019. Not necessarily increases in seed prices, but as our crop prices, output prices fell, seed prices didn't lower. They did lower starting in 20 and came down just a little bit, but not back down to that 12% of gross. And talking with input suppliers here the last couple of weeks, probably expecting a 10 to 15% increase in price of seed for corn seed for next year. They've been holding it steady, and I'm guessing they're wanting to get that back up above that 14 or closer to 15%. They feel they can probably capture that, and we'll see if that comes about. Fertilizer took of course it did in 8, but then in 12 it jumped almost to 17% and stayed above that till 2020, and then saw a couple years of falling. And then of course this year coming into fall, just went nuts and went quick. 23, and I'll talk more on fertilizer going forward. It's kind of a toss-up. I would not expect it to drop a lot, but there are things in play that could possibly make it fall. This would be rent that producers pay on the land. Because when I do this, I did like a cash rented ground, so it is all rented. It doesn't say whether those are favorable rents, but like renting from themselves or those type of things, but it's going in, that's what it's reported. So that moved to 30% in 2014, adjusted lower in 2022, and kind of seeing that increase. Probably in South Dakota on corn, as you move further west, 22 to 25% is kind of a good number of gross. It starts getting much above that on all acres, then it gets tougher for those guys to remain in top profit area. Machinery moved to 18% of gross in 2013. It did come down a little bit in 20 and 21. Now, going forward, I would expect probably at least a 25% increase in machinery cost. That's not that it would move to 25% of gross, but a 25% increase of where it is in 22. And that's just going to be parts, fuel, and possibly new if they're adding some new equipment in depreciation. Machinery, you're talking now, it's going to be different than it was in, say, 2008 or 9. When we went into the low period and they had a lot of machinery produced, you look around at dealer lots and they don't have a lot of extra used equipment sitting around and or new. So a lot of that inventory is being held by farmers, being used. So even if we get a downturn and recession and move down in our crop prices, machinery costs could still stay fairly high and on the purchasing end of newer equipment or new equipment to your farm or the individual's farm. The other thing you're probably seeing used to be you could, as a producer, if you looked out 6 months to a year, anticipating machinery needs, you could probably go locate that. That is stretched out to almost 2 years now. So producers need to be looking farther ahead than they have in the past in working to secure that machinery or equipment that'll add efficiencies to their operation. Management approximately 10% in 2014. That tends to go up and down and kind of stick around that 6 to 7%, probably just in the way that it's calculated, mostly for those that are reporting to this database. So here's our fertilizer comparison. I do it from 2006, or not, 10/6 of 2020 to 12/28. So showing where it was a year before and then last fall. And over on the side, I got the nitrogen trivia from September 1 to 11/15. That's how fast it rose. And as guys were busy doing their production stuff, if they weren't in tune to what was going on in the fertilizer, or didn't have time to book, or weren't ready to, it just really shot up quick in those last few months of 21. So just showing them, and this is taken from what's called the Iowa Cost of Production Report, and that comes out every 2 weeks. So that's where I got this data from. And then then I look from 12/28 of 21 to the last one that came out was 6/28. So almost a couple weeks ago. It's amazing how high our diesel went and increased through the spring. So guys may have been able to lock in, but harvest is going to be more expensive probably coming up this year with propane prices and diesel prices. Fertilizer continued to rise. Now, urea did drop fairly strong coming into July, and that would not be captured in this report. So just this last week, I reached out to some suppliers, and their urea right now was right at 615. It seems crazy early time to book, but if a person was go back to Tong's data, I was just jotting some things down as she was going through that. That end price, the end price per pound compared to a corn price ratio was around 10 to 12 for many years, and then as it took its spike here, it went up to 18. And if we use the 615 that I just threw out and say a $5 corn for next year, which you can price in, that puts that ratio right at 13 and almost 13.5 cents, or 13.4. So I think the thing, if guys are looking at it, they probably need to sell some crop against it if they're looking at buying. We're still at high levels, we're not down to that 10 to 12 yet, but it may be an opportunity for some. So looking at fertilizer, a couple things that could be decrease the price, and then a couple things that would have put pressure to increase price. So if we are headed into a recession and financial, we'll just call it financial crisis, it's a cycle. I shouldn't probably call it a crisis, but headed in that downturn. In 2008, we just saw crops continue to fall, and fertilizer went down right with it and stayed down then. Probably both of them, at least into 2009. Is that going to happen again? Well, it's kind of started to, but we'll see. I think weather's going to dictate a lot on the crop price. And we'll see how we can handle coming through and reducing inflation and working through recession. So right now, that would have probably a negative impact if we do had recession, crop prices stay down on fertilizer prices. Russia, the major exporter, well, when this spring, it was kind of understood that probably no fertilizer, that there would be sanctions on fertilizer coming out of Russia. Well, they're a major exporter, and countries are willing to buy, so it gets added to the world market. And the more that they are able to export, the lower it goes. So that had somewhat of a negative impact on fertilizer prices, which is good for our producers. Now, looking at things that would add price to fertilizer is there's been talk that the natural gas shipments could be cut by 40% to Europe. And if that happens, you start to get into a situation where it's residential use versus industrial use. Now, the farming and production of fertilizer would be high priority on the industrial side. But if it comes down to heating homes and producing fertilizer, heating homes is going to take the priority. And so we could, if they actually cut that by that much, it's going to not bode well for production of fertilizer out of Europe. China is a major urea and phosphate exporter, and they've had a ban in place since last fall, which was supposed to come off I think in June, and it hasn't come off yet. So will that continue to ban their exports into next year? We don't know. So that also now has positive pressures on fertilizer prices. Now, switching to our inflation and some interest rate looks. So I just picked some lines across here, somewhat arbitrary. The Federal Reserve, their target inflation has been that 2%. Now it's going to always bounce around that 2%, but it's been a long time since we've seen it increase like it has, and they've done a good job of being able to keep it steady. Makes it good economics for business to plan and make long-term investments and projections and follow through with those. And now we've got this big rise, and I just drew a line at 5%, kind of picks up a couple of these peaks that were back in here. But as we came out, it ended up at 9.1 this last report. And so if we just took it historically, are we here back at 78, 79 or so, or are we back in here at 72? I don't know. It's just things to think about and look back to those that were around and see how they managed through those times. Then just a chart of the 10-year Treasury, and just showing that, and then we'll lay the two together. And again, the blue being the inflation and the red the interest rates. So I think we come out here and we see how high our inflation rate is, and yet we haven't moved very high yet relative as our 10-year Treasury. So it would indicate that we probably got to keep raising those rates to bring inflation under control. Then just looking at some different rates, and if Matt or Lucas wants to make comments on some charts that they supplied with me, that's fine. Just jump in and we can add that to the conversation. So overnight rate starting over here at the left and then moving on 5-year, 10, 15, 20, and 30. So I'll kind of pick on these out at the end on our 30-year rate. Looking at the January of 20, we were just a little over 2.5%, and then fell as we went into December of 20. Of course, our COVID and promoting low interest rates and trying to keep things going. And in November 21, it was still fairly low. And now we've seen things start to take those jumps as we're trying to bring inflation under control. Still not the, the 8-10%, but it is something that needs to be put on the radar of people managing large amounts of capital. Then just taking an example from our South Dakota Center Farm Ranch Management, which is housed at Mitchell Tech, and Matt and Lucas pulled what their annual interest expense was, which is close to $66,000, and 61 of that being cash payment, and the other the change in accrual for 2021. So doing that, our interest expense ratio was 4.1. Still not bad. I think if we went back and looked at our 80s crisis, that probably jumped closer to 10-12% of growth. So not bad, but it's things that we'll want to keep track of. So then we made just a hypothetical situation and where debt was. So current operating note of $528,000, intermediate of 165, and a long-term land of 1.8, and those being the rate. So then we'll test those rates going forward. Is the other thing to note here is the operating loan is assumed that it's only held for 6 months. So then adding 2 percentage points to that rate on our current note, we see that increases, and assuming that 10% of the land has to accrue at a higher rate. So we also then see an increase. It moves our ratio up to 4.9. Still not crazy, but it's going in the direction against profitability. So needs to be put on the management radar. And we move from just using our cash amount or expense amount of 77,000 from 65,000. So another 12,000 or so that they had to come up with, or will, I should say, in 23. So things to think about going forward. I think we're probably on the start of the effects of this interest rate, and we'll see how inflation starts to behave. We had the one that just came out. We have seen some drop in fuel, but is that going to stay, and is it enough to actually lower somewhat the inflation? I think the Fed meets a couple weeks or in a week or so, and we'll see what their talk is. Now, just a few charts on price. The WASDE report that came out earlier this week, I think, was really just overshadowed by recession information and that wasn't necessarily all that negative, but prices sure have been dropping the past few weeks. And I think most of that is just fund money pulling out, taking profits and moving to the side or other investments and looking to see where this inflation and financial issues may shake out. So just looking at this would be winter wheat, and I just pulled these this morning, so I was right at 840. I think support would kind of be at that 816 to 820 range. And then your resistance probably right in a $9, you know, just picking some logical probably steps there that might fit. Spring wheat probably right around 865, and then falls probably to 850, kind of as a support area if it, depending on how it closes out the week. Of course, we're looking at a daily chart here, but those are just some things that I picked out. And corn, let's see, 565 kind of at our bottom here. And then if it goes, you know, then it's probably another dime below that if it would happen to fall through that. I think weather's going to play our bigger key going through the next few weeks. Almost, if we look at our crop progress report and go back and look at that from planting progress this spring, 50% of the corn was probably planted within a week to a week and a half. So across the nation, this next couple of weeks, weather's really going to matter in corn. And I heard a disturbing one yesterday where a guy had traveled through Nebraska, and I haven't been down there. So if somebody knows more, that's fine. I'm just passing on that there was a lot of pivots that had gotten knocked over with the wind. I don't know, you know, if you drive through an area and they're all knocked over, it looks like they're all knocked over across the state. But I haven't heard that other than just an anecdotal comment. So, and then soybeans, looking at kind of that $13 mark, and then probably falls another 20 cents to 12.80 if it would happen to break through the 13. And then of course would have the, you know, 13.50 kind of dime to 20 cent moves going up as little resistant type things. I think weather will be our key. Soybeans, you know, that can stretch you out a little more. The other thing on soybeans, probably more prevent plant acres to show up going forward. I don't know that that'll have a big effect, and news and chatter's probably going to talk about it, but a lot of those are out of North Dakota. And yes, North Dakota raises soybeans, but as far as a total market share, it's not large. So just in concluding, I think our financial management and working capital, those things, and monitoring cash flow are just going to be increasing in importance as we finish out this growing year and move into refinancing and going to work for next year. That's what I have.
Okay, well, thank you very much, Jack. We appreciate that information.